Inflation figures for the month of April have started pouring in, and the numbers present a very stark contrast between India and China as the world's largest economies. Now, India's retail inflation rate eased slightly in April, partly due to lower fuel prices, although food prices remain elevated. Annual retail inflation in April was 4.83%, down from 4.85% in March in India. Food inflation, which accounts for nearly half the overall consumer basket, rose about 8.7 in April compared to 8.52 in the previous month. In China too, consumer inflation quickened in April, holding just above the zero mark for the third consecutive month, while industrial prices extended a long decline, highlighting weaker demand in economy. The consumer price index rose 0.3% from a year earlier compared to an increase of 0.1% in the month of March. Factory gate prices remain stuck in deflation as they have been since late 2020, with the producer price index sliding to 2.5 in April from a year earlier. The numbers suggest that deflationary pressure remain a threat to Chinese economy despite green shoots in manufacturing sector as well as robust export. Karthik Malhotra joining us here in the studio along with Krishna. Karthik, you look at the stark contrast between these numbers. So while India on one hand is dealing with inflation, China is trying to get out of deflation.
Absolutely. So, the target that India has set, the central bank has set for itself is 4% inflation. The target that the Chinese central bank has set for itself is 3%. And now look at the stark contrast. India is nearing around 5%, wants inflation to come down to 4%. China targeting 3% is actually hovering in the range of just about 0.3% or so. So needs inflation to go up. And that is pretty much now dictating policy action as well. For example, India is unable to cut rates, and India's rates continue to be elevated simply because we are unable to hammer down that inflation down to 4%. And China, on the other hand, is actually cutting rates at a time when the rest of the world is increasing rates. China has been cutting rates, and the last rate cut happened by 25 basis points in the month of Feb to actually inch up inflation slightly. So obviously, two very, very different contrasting scenarios emerging from two neighbors and two trading partners, so to speak. And that's the kind of times that we live in.
Absolutely. Let's talk about India for that matter. So inflation in India not under that 4% mark of RBI just as yet. So India, of course, the prices will continue to hover where they are at the moment, with a rate cut perhaps later in some part of this year, if at all. While for China, it's the exact opposite, as you just mentioned. They are cutting down rates and they will continue to cut down rates. Consumption in China is not picking up from the numbers that are coming out.
And consumption again is a function of, your rate cuts actually impact which sectors. You as a consumer will get impacted with a rate cut if you're looking at buying property, if you're looking at buying a high value purchase, taking a loan from a bank. So the two most obvious scenarios that come to mind is you as a consumer want to buy a house, or you as a consumer want to buy a car. And that is when you go knocking on the bank's door asking for a loan, and a lower loan is actually going to help you or make that particular purchase more affordable for you. Both these sectors, incidentally, in China have tanked. So you're unable to sell property, and you're actually not even able to sell as many cars that you would like to. The exact opposite is actually happening in India, where you're in a high interest rate regime, where your loans are expensive.
And yet the consumption is crazy.
You're buying retail like never before, and you're buying real estate like never before, and you're buying cars like never before.
All right, so there's a very stark contrast there. But for those of us who really need to understand how deflation and inflation work in China at this point in time, what we are looking at is lower interest rates, and yet people are not buying. So how do you really explain it?
So as I see it, there's a fundamental problem right now in China, Shweta, and and that has to do with the government in China actually doling out that surplus, which has been pending for years now. So, if you go back in history, the last time that India and China were both comfortable with inflation numbers was pre-pandemic, was in 2019. And it's only in 2019 that you saw that China had an inflation rate of about 2.9%, just very, very near to the 3% mark. And India's inflation was near about 4%. It's been 5 years, both countries have been struggling with inflation stroke deflation. Now, to come to your specific question, I think the Chinese people need money in their hands, and that money is hard to come by. And look at, you know, the story that you opened the show with. US is now imposing fresh tariffs on China, which means the factory output from China is going to actually become double the cost if you talk about electric vehicles, which are now going to attract almost 100% tariff. So why will anybody in the world want to buy a China-made electric vehicle, or a China-made semiconductor, or a China-made battery, or a China-made solar panel? And on all of these, tariffs are now going to come at 50% and upwards, which means job creation in China is going to continue to be a problem, and there is going to be some way through which the government will have to inject liquidity in the system to get people to at least go out and buy, and that should be a driver for the Chinese economy. But data coming on China's own economic growth is equally surprising, because China is saying it grew 5.2%. From where?
All right, so the numbers don't quite make sense. So I'm coming to India, and before we move on from this story, in India, the picture is exactly the opposite, as Karthik pointed out. Despite a very high interest rate regime, it does look like, at least for food inflation, although high interest rate has very little to do with how food prices will pan out, that continues to be a problem at over 8%, Krishna.
Right, those are the only dark clouds in all the greenery that Karthik pointed out. Yes, of course, for that 4.83 level of inflation to come down to the manageable 4%, which both the government of India and the Reserve Bank of India, before it even gets close to any kind of cutting rates, it would want it to be at least below the 4.5% range. And for that to happen, food prices have to cool down. And we really, unfortunately, the factors controlling food prices are not very controllable. So hence, it's going to be, and you've seen the headlines hitting the home cooked veg thali prices inching up month on month. So I mean, if the vegetarian thali is going up, no questions asked, the non-vegetarian thali is also going up. So the thalinomics is not really working out for India at this stage. But the fact of the matter is that all it needs to be done is to be brought, that increase is to be brought under controllable levels. It is going to increase one way or the other. If it can be brought down to controllable levels, less than 4.5%, closer to the 4% range, then the Reserve Bank of India will even think of the possibility of cutting rates at some point of time during this calendar year or this fiscal year. But for that to happen, time will tell whether that's going to happen quickly or not. But that's certainly a problem that India will deal with, even as it looks at the fact that the consumption story is going strong, and that's very important for India's GDP numbers. India is, if it wants to push up its GDP numbers, the consumption story has to keep booming. Indians have to continue buying everything from cars to real estate to flooding the malls over there. But then, of course, there are stories of how so many malls have become ghost malls these days. But then so many Indians are, of course, shopping online instead of going to the malls. So that the consumption story, apart from
unabated,
is unabated. That's fine, but there has to be some rational, the rationing of food prices, and that being brought down to more controllable levels.
All right, food inflation at about 8.7%, not going down too well with a lot of common people out there. But look at the stark contrast figures on your screen at this point in time of inflation in India versus China. Inflation in the month of April for China at 0.3%, for India at just over 4.8%.